The End of U.S. Exceptionalism, a story of fading U.S. dominance and tectonic shifts in financial markets. For years, the U.S. has been the world's economic engine, its markets a global piggy bank, propped up by a massive capital account surplus and a seemingly invincible dollar. But that era seems to be unraveling, and our measuring stick might start to matter a lot more in the coming years. For most people, the dollar is their only denominator. They look at the entire world through U.S. dollar terms. That measuring stick may be broken, however, and set for some seismic moves. Today, we will show why the denominator will matter so much in the coming decade and even look at some potential trades. Stick around to the end to see a pretty mind-blowing lesson for where markets might be headed. So as I've been talking about for the past year and a half, as the U.S. runs a large current account deficit, a large trade deficit, remember, there are two main accounts for each country on a balance of payments basis. There's the current account, and this is mainly comprised of the balance of trade. And then there's the capital account. And so just structurally speaking, when you run a large current account deficit, a large trade deficit, as we can see right now, it's about $300 billion a quarter, so about $100 billion a month. What that means is that $100 billion per month must flow into your financial markets. You must run a capital account surplus. Some have even argued that our trade deficit is caused by the capital account surplus. As global capital flows in to the U.S., into U.S. financial assets, this has actually driven the balance of trade deficit. I don't have an opinion one way or the other on that, but I think it's an interesting thought experiment of which came first. Some have argued this capital account surplus is actually what's driving our current account deficit, our trade deficit. And of course, we know the top 10% in America own 93% of U.S. stocks, U.S. equity exposure. We know the affordability of the housing market and how stretched that has gotten. This is one of the structural reasons why. There's a huge amount of money, $100 billion per month, that must flow into U.S. financial markets. This is just the way the system is set up. We kind of told the world, okay, we will ship you our factories and our industrial capacity, and we'll sell you NVIDIA at 50 price to earnings ratio. We'll sell you U.S. Treasuries at 4% yield, 10-year Treasury. So this is just kind of the agreement that has been made. We will run the best capital markets in the world. The freest, right? The least regulation. They will perform very, very well. And you will recycle capital into our financial markets. Well, this is great for the top 1% who own all the financial assets. They just got a structural bid under the price of their portfolio. You have $100 billion per month or $300 billion per quarter flowing into things like the S&P 500, NASDAQ, Mag 7 stocks, but also U.S. Treasuries, also real estate. So this is a super important driver for the performance. The reason the S&P 500 has done so well is there's this structural component to it, $100 billion per month. So here we have the S&P 500 in dollar terms in white, and then denominated in other currencies. And this goes back to 1990, which is really when globalization took off, and the American economy became hyper-financialized in the early 90s. And we can see since then, in dollar terms, the S&P 500 has returned 1,500%. This is a great return. But in yen terms, it's returned 1,700%. In euro terms, it's returned 1,900%. And in pound terms, in British pounds, it's returned 2,255%. The reason that it has performed better, in these other foreign currencies is because the dollar has strengthened during this time, during the past 35 years. The dollar has not only has the S&P 500 gone up in dollar terms, as we can see in the white line, but the dollar has also appreciated versus all of these other currencies. So if you're a foreign investor, foreign hedge fund, foreign capital allocator, you look at the performance of the S&P 500 in dollar terms, you go, well, that's very, very strong. Okay, great. But then you also look at the fact that the dollar, generally speaking, will kind of always strengthen versus your local currency. So think about it. You earn income in yen, but that yen is depreciating, is getting devalued day by day by day. It takes more and more yen to buy the same good. Um, and yet, you have something like the dollar, which is appreciating versus the yen, right? It takes less and less dollars to buy 1 yen. So the dollar is strengthening. Well, what you would do is you would sell your yen, buy dollars, right? This puts upward pressure on the dollar. And then you would use those dollars that you just got in your currency exchange. You'd use those dollars to buy the S&P 500 and return 1,500%. But then eventually you're going to sell. And when you go to sell your S&P, now you have dollars. You take those dollars, you live in Japan, you need yen. You take those dollars that you just got from selling your stocks and you sell the dollars, downward pressure on the dollar, and you buy the yen. This is upward pressure on the yen. So downward pressure on the dollar, upward pressure on the yen. Well, now that you've done that, you actually look at your return and it's even better than what it looked like in dollar terms. Now you're up 1,690%, because when people talk about the dollar, this is kind of what they're really talking about, which is dollar denominated financial assets. The S&P 500 is dollar denominated. So during this 35 years that this Japanese capital allocator was in the S&P 500, he was also in the dollar. He was also invested in the dollar. Now, of course, if you are worried about that denominator, right, the currency, if you are worried about moves in the currency, you can hedge that currency risk. Well, something like 9 or 10 trillion dollars of U.S. equity exposure is currency unhedged. Because remember, to hedge, you got to pay money. And that brings your return down. If the dollar is always going up and strengthening generally, and the S&P 500 is always going up, why purposefully lose money? Why hedge the currency risk when the dollar always goes up? There's no need to hedge in their eyes. And so there's something like 9 or 10 trillion of unhedged current equity exposure. So there's another side to this, which is here. So here's the S&P again, denominated in all those local currencies. And we kind of zoomed in, and we can see that since April of 2020, in yen terms, this is the same underlying S&P 500, just denominated in different currencies. You can see how much stronger the S&P in yen terms has performed versus the S&P in dollar, euro, or pound terms. What this is the yen depreciating. You can see it traded basically in line here through 2021 and into 2022. The white and the yellow line were basically the same line, but then they started to diverge, right? And the reason for this is the yen started to weaken. Remember, what good is a huge return in whatever asset you're invested in if your currency during that period of time you were invested also weakened an equal amount, right? You have to start looking at the denominator and how much that denominator is moving. And so hopefully this paints a picture. Since April of 2020, the S&P in pound and euro terms, it's much more in line. The reason for this is that the pound and the euro have not weakened nearly as much as the yen. Well, now I think it's important to kind of zoom in to where we are now. So I'm going to zoom in, hopefully try to keep this. I will make it year to date, this chart. So we will zoom and start the chart at 2025, just about there. And you can see that when we start the chart in January of 2025, you can see that the S&P 500 in dollar terms is up about 1.6%. Okay, great. But what about that foreign investor that is in Europe or Japan? You can see they're down. So even though the S&P had this tremendous recovery on the kind of flip-flop from the administration on tariffs, even though it had this massive recovery, you can see that if you're that foreign investor and you did not hedge your currency risk, you can see you're down. Even though U.S. investors are up 3% year to date, you can see that you're in your local currency terms, you actually lost money by investing in the S&P 500 and not hedging your currency exposure. And we can see that 6.5% down if you're a European investor, 5.2% down if you're a Japanese investor, right? So when the S&P 500 had this tremendous recovery, a lot of people talked about, will it set a new low here? It came down, had that huge day on the 8th. Where there was the rally, and people were talking about, is it going to come back and retest that low that it made right there? Well, in yen terms, in euro terms, and in pound terms, it actually made a new low, as you can see by the blue, yellow, and red line. Um, which I think is interesting because a new low signifies, if you're a trader, that new low is a huge indication to you versus what it looks like in dollar terms, which is much stronger. Well, the reason for this, you can tell that they were trading relatively in line here before all the trade tensions, before all the kind of turmoil. Well, what happened? The reason they diverged is the dollar started to weaken. And so remember, what good is a let's just use very simple numbers. What good is a 3% return in dollar terms if the dollar weakened by 3%? Right. So the denominator and the performance of that denominator matter a lot more. So here we're looking at a bunch of different stock indexes. The S&P is the main one for the US. We're looking at the FTSE, that's the main index for the UK, right? IBEX, Spain, CAC, France. And these are all denominated in local currency terms. And what we can see is that going back to 1990, again, when kind of hyper-financialization for America really started and kind of globalization really kind of accelerated, we can see during that time, the S&P 500 in dollar terms, it's a dollar-denominated asset, has wildly outperformed, up 1,600%. The DAX, which is the German index, has performed strongly here, up 1,200%. But look at all these other index. Look at the Nikkei, which is the Japanese stock index. Look at the DAX, excuse me, the CAC or the IBEX. You can see that these, or the FTSE for the UK, these have all been basically sideways for the past 20 years, 25 years. Meanwhile, the S&P in dollar terms has just wildly outperformed. Well, this, if you live in Spain or France or the UK or Japan, why would you invest just psychologically? Let's think about this. Why would you invest in your local stock market? Well, you wouldn't. When the S&P 500 is doing this and the dollar is also appreciating versus the dollar is also giving you a boost. You're also getting a return from the dollar appreciating versus your currency. Well, you wouldn't. You wouldn't invest, and we see that just on a psychological level. We see, when this really started to take off was kind of the early 2010s, where the S&P just started to run away, and it really just kind of started to wildly outperform. This is that U.S. exceptionalism that people talk about. If you're in Spain, why would you invest in this blue line? This has gone straight sideways, going back to 2006. You're up maybe 1% in local currency terms, and it's even worse in dollar terms if we look at that. So hopefully this illustrates why, but behind some of the things that we've seen over the recent history. So here is the S&P in dollar terms. Here's the Indian stock market in rupee terms, their local currency, and the Brazilian stock market in British real terms. This goes back to July of 2008. You can see it looks like, oh, well, why would I invest in the S&P 500 in white? It's only up 370%. I should invest in India. It's up 521%. That's 80% higher than that's quite an extra return I would get investing in India. Brazil does not look so strong. But remember, the denominator matters. What good is a 500% return if the currency, if the rupee, which is what the Indian stock market would be denominated in, you're in the rupee for as long as you are invested in India, in their stock market, essentially, generally speaking, you are in the rupee. What good is a great return, a 10% return every year, if the rupee is weakening versus, say you live in America, you convert your dollars to rupees to buy the Indian stock market and you're getting 10% a year. Okay, that's great. But what good is that if the rupee is weakening against your dollar, which is really what you want or need? That is where you live. You need dollars to survive because you live in America. What good is that 10% per year of the Indian stock market if the rupee is weakening by 10% per year? And so this shows that concept. So here we're looking at everything denominated in dollars. Again, you can see that now once you've adjusted for the denominator changing, right? Because again, what the reason the blue line is higher than the white line here is because the rupee has weakened versus the dollar. Once you put the same denominator for all of them, for all these three stock indexes, what you can see is that the S&P 500 wildly outperforms. And this is in constant currency terms, right? You're using the dollar for all of them when you're evaluating this. You can see that the British the British stock market in dollar terms is down 29% in the past 20 years. It is down 29%. Yes, the Indian market has done slightly better and is up 120%, but that pales in comparison to the S&P 500, which is up 340%. So this adjusts for the denominators, the currency moves, right? You denominate everything in dollars. You can also do gold, and that's where you really start to see the true performance of things. So just to really like hammer that point home, here's the Argentinian stock market index in local currency terms. And we can see it is up 51,000% going back to 2013. 51,000%. Well, now let's look at the Argentinian peso. This is their currency. This is what the white line is denominated in. Here is that Argentinian peso to dollars cross rate, right? We can see that it weakened from 0.184 per dollar all the way down to 0.0008. It has just been weakening tremendously, and you can see the devaluation here in 2015. It has been weakening. So what good is a huge performance like this if the currency, which you're kind of in by definition, by being in the Argentinian stock market, you're kind of in the Argentinian peso. Well, what good is a huge return in peso terms if your currency is collapsing? And this is exactly what we see, right? Their currency, as most people know, has just utterly collapsed. And so here is the Argentinian stock market in dollar terms. And you can see it's a much different story. I will merge all the scales into one so we can see the degree to which this outperformance. So here, going back to 2011, in peso terms, using the collapse in currency, you are up 69,000%. But once you adjust for the fact that the currency is collapsing, and you look at the Argentinian index in dollar terms, you're only up 100%. So this difference, this illustrates the degree to which the currency is playing a role, right? By looking at the gap here, that is how much the currency has weakened. Because this red line is the Argentinian index denominated in dollars, and the white line just really is optical illusion. And this applies not just to Argentina or Turkey, which we know these are extreme examples, but this goes on everywhere. This is also the case in the U.S., where we've had just in the past 20 years or so, the purchasing power of the dollar has collapsed by like 40%. That is not nothing. So when you see the S&P 500 and it just looks so strong, remember, number one, the current account and the capital account, and that structural flow. But also remember that, $100 bought you a lot more back here in 2002 than it does here, right? This principle that we're really trying to hit home, this applies to America. This applies to England and Europe and Japan. This applies everywhere. This is not just, the kind of extreme examples like Argentina. It's more pronounced in Argentina, but it's not just there. So here's the Turkish stock index, another kind of extreme example. And we can see, very similar looking shape to this chart. It is just skyrocketed. Well, but this is in lira terms. This is in the local currency, and that local currency is collapsing. So how can we see that? Well, here is gold, the price of 1 gram of gold in Turkish lira. And we can see the degree to which the same thing, right? 1 unit of gold, 1 gram of gold, it went from costing 430 lira here in 2021 to now 4,000 lira. So 100x in that period of time. This accounts for the collapsing value of the currency. The other way to think about it is this. This is the purchasing power of the Turkish lira, right? When you look at something like the gold price, you invert that, and that's basically what the market is pricing in for the purchasing power of that currency. And so this is the purchasing power of the lira as illustrated by the gold price. And so when you see these hockey stick charts, when you see, and this applies to the S&P 500 too, to a lesser degree, but still to the S&P 500 and American investments and markets, when you see this, you need to account for the weakness that currency has experienced. And basically all currencies have a loss in purchasing power. All modern day fiat currencies, generally speaking, lose purchasing power over time. We live in this kind of Keynesian inflationary environment where all the policymakers believe you must have inflation. The value of people's savings must decrease. You must have inflation. So this is true not just in Argentina, not just in Brazil or India or in Turkey, but everywhere. This is any modern fiat currency is going to have similar characteristics because in a highly levered system where debt is money or money is debt, a debt-based system like we live in, you must have an ever-expanding monetary supply, right? Because you are levered. So, and the value of your collateral can never go down. The value of the collateral must always go up. So what you get is kind of incentives and structural elements that drive some of this stuff. So here's the price of Bitcoin. The same concept, but the price of Bitcoin in Turkish lira. And we can see from 2021, it went from costing 411,000 to now 4 million. So again, you compare that to the gold, the run up in the value in gold terms, and it's very similar. What that indicates, that is confirmation that this performance, these lines going up, is not that the underlying thing is getting more valuable. It is that the denominator is collapsing in terms of purchasing power. So trade ideas. So I pointed this out, I think December, January. I was looking at this kind of concept of all that capital that is accumulated that was instead of going into local markets here in Europe or elsewhere, all this money that's accumulated in the U.S. markets. Well, what happens if it starts to go home? What happens if they start to sell their investments? There are tens of trillions of dollars built up in this kind of dollar carry trade, this dollar flywheel. What I noticed was when you take the IBEX, this is the Spanish stock index, and you divide it by the NASDAQ, this is what we're looking at here, you can see that the IBEX has underperformed the NASDAQ to a huge degree. This goes back to 2003. It has underperformed to a huge degree. Here was when I noticed this kind of divergence. This is something called a bullish RSI divergence. This is what we're looking at down here. So this is called the relative strength index, and it's a widely used indicator within the kind of trading, financial market, investor community. This shows, is a asset overbought or oversold. And we can see that it dipped into oversold level. Anytime you go below 30 right here, that is considered oversold. The IBEX is too weak versus the NASDAQ. And so what you had was you had the actual performance of the underlying thing. You had it set a new low, but at the same time that it was setting a new price low, right, which is what we see this here in December of 2021, it set a new low in price. You had an RSI divergence where it did not set a new low. In fact, the relative strength increased and set a higher low. This divergence was really kind of interesting to me, and I put out a post on X. This was several months ago, and I think all the indexes that I've looked at, denominated in the NASDAQ, they all look like this. They all have this bullish RSI divergence, and seem to be setting a bottom. I mean, if you look at this, you can also see a kind of an inverse head and shoulders here. And a pair trade for long IBEX, short NASDAQ. Now this trade has been talked about, from the time I put this post out, a lot of people are kind of talking about this concept and this potential trade. So it might be quite crowded and might not be the best time to put that trade on. But you're talking about if all that capital starts to go home, you are talking about tens of trillions of dollars of capital returning to things like Spain, the Spanish index or the Japanese index or whatever. The other side to that too is that, remember, to get to the IBEX, they're in the S&P, and that's a dollar denominated asset. So they must sell the dollars to buy the euro, right? Spain is in the eurozone, so they have to buy the euro to really reinvest their capital. They would have to sell the dollar and buy the euro. If this really gets going, this could cause dollar weakness. Well, sure enough, what have we seen? We have seen dollar weakness as this tens of trillions of dollars. This is not going to happen overnight. This is not going to be an instantaneous cataclysmic event, most likely, in my opinion. This is more of kind of just a headwind. This kind of around the margin. It'll be a headwind for U.S. financial assets. They can still go up. They can still have modest nominal returns. But remember, what really matters is the denominator. If the dollar is weakening, if the S&P goes up 2% this year, but the dollar weakened by 3%, you lost money. So people need to, I think, really start to, especially in America, really start to reorient their view away from just the dollar is the best measuring stick, and start thinking about things more in terms of denominating in other currencies, other goods like gold and Bitcoin. And what you see is a much different story. So here's the DAX. This is the German index divided by the NASDAQ. And again, the same. And by the way, I will point out, this happened in 2020. This divergence here, where it set a new price low, but set a higher low in relative strength index. And this is a monthly chart. There's not much noise going on when you're looking at monthly candles. This is a huge amount of time in each candle. This is much more meaningful than looking at this on a 1 hour basis, for example. This happened 5 years ago. This relative strength, this bullish divergence, this all happened 5 years ago. I've pointed out the Euro USD cross and the interest rate differential diverging. I think it was like 3.5 years ago. Some of these things have kind of been building for a long time, and we might just now be seeing kind of the excuse to really kind of accelerate some of these this repatriation trade. So here, this was like what I mentioned in the intro. Here's the NASDAQ in dollar terms, and here's the Nikkei in yen terms. And this is it going into 1989 into 1990, and this is the NASDAQ up until the present. So I'll take it a little further there, so we can see we're currently right up here near the high. This is what the Japanese index looked like heading into 1990. So what happened after 1990? Well, we will show you. It sold off 80%. Over the next few years, it crashed. And there were issues with the currency as well. But I just, when I was looking at these foreign indexes, one of them was the Nikkei, and I was on a very long-term time frame like this, and I saw it and I go, oh, that looks strikingly similar to the NASDAQ. Now remember, again, when we're looking at this NASDAQ, remember how much the dollar has depreciated, right? This might look great, and sure enough, it probably is a positive real return. We can see that by dividing by, say, gold. I bet it is a positive return. The NASDAQ is more levered. Yeah, we can see that, going back to the late 80s, early 90s, you are up in real terms. So NASDAQ divided by gold, you are up in real terms. But if you bought during the dot-com bubble, you are down. And we have not set a new high, not even gotten anywhere close to setting a new high from 2021. So this is much different than looking at the NASDAQ in dollar terms, remember? So if you bought here in January 2021, you are actually down on your NASDAQ position in real terms, because gold is telling you the dollar has fallen. The dollar has depreciated significantly during this time that you've been holding the NASDAQ. The dollar lost purchasing power. That is what the gold denominator is telling you. And so I think, this is kind of the framework that I've been developing over the past few months. Is this: we might see nominal returns, positive nominal returns, real estate. I've been saying that for real estate for 3-4 years. You might see nominal returns, but in real terms, it might be a much different story. And when I'm talking about real terms, this is what I'm talking about: the NASDAQ divided by gold, the S&P 500 divided by gold. Here, because I know that there are some people that are probably yelling at their screen to do it in Bitcoin, I will do it in Bitcoin. Here's the NASDAQ denominated in Bitcoin. It has massively underperformed Bitcoin. We can see that here. I'll adjust and make it a logarithmic chart so that you can actually see what's going on. This is adjusting for exponential changes. NASDAQ has massively underperformed Bitcoin. So, these scarce assets, and the same is true for the sales price of a US house, right? So you look at the price of a single family home in America, and remember, a house is still just a house. I've tried to really hit this point so many times. The reason this price is going up is not that the house got more valuable. Maybe around the margin, yeah, 1 or 2% of the price appreciation is due to better technology or efficiency or whatever, but it's marginal. The real reason that housing went from costing $20,000 for a house in 1963 to $500,000 for a single family home, the real reason, what really drove that, is that the dollar lost that much purchasing power. So when you look at the price of a home denominated in gold, this illustrates that housing is not the problem. The problem is the plummeting purchasing power of the dollar, of the denominator. We can see that it only takes 151 ounces of gold to buy the average house today at record unaffordability levels. This level's really never been hit before. This is the logarithmic scale, make it regular. So we can see that, going back to the 60s, housing has actually never really been more affordable. In gold terms, in real terms, the reason housing is so utterly insanely expensive is because the value of the dollar collapsed that much and wages did not keep up. This is the real reason. Of course, interest rates play a role here, but changing the denominator and accounting for issues with the denominator, the same that a foreign capital allocator would do with their investments in the S&P 500. People need to start looking at things, I think, in fresh or different ways. I think if you just keep looking at things in dollar terms, remember, like, this was a big deal that it didn't set a new low. But in yen terms, in pound terms, it did. In euro terms, it did. I think that this divergence, right? We've seen weakness in the dollar, since that kind of early April turmoil. If you continue to see weakness in the dollar, remember how much of this money that has flowed into the S&P 500 instead of the local index. Remember how much of it is currency unhedged, meaning if the dollar starts to fall, they are down already. But if the dollar starts to weaken even more, the S&P could go sideways, and they are losing money, right? If you assume the S&P just goes sideways from here, but the dollar falls, well, that European investor goes from being down 6% to down 10%, 15%, right? The S&P is not doing anything. It's just going straight sideways, but the dollar is falling. So all this global capital that we have accumulated as a result of our massive trade deficit, our massive current account deficit, all this capital that has flowed into the U.S., into U.S. financial assets, they might have some strong looking returns, but when the dollar starts to weaken versus their local currency, that picture changes. And so hopefully, this example with Argentina, with different denominators, right? The Indian stock market in rupee terms is up 515%, but when you look at it in constant in dollar terms, you can see it's actually only up 120%. Hopefully some of these concepts are really kind of starting to become clear. This is the reason the Argentinian stock market looks like a rocket ship, is because the currency has just collapsed. The currency is completely collapsed in value. So hopefully, this helps not only foreign people, but also Americans, because Americans never really had to think in these sorts of terms before. If some of these trends start to accelerate, whether it's repatriation, whether it's weakness in the dollar, which I will remind people, this administration, if they really want to accomplish what they say they do, reindustrialization, they need a weaker dollar. And it's not because the dollar's, too strong. The dollar is too strong. It's not that they want a weaker dollar than is fair value on a balance of payments basis, on an interest rate fundamental basis, the dollar is grossly overvalued. This means that the administration will not be able to accomplish their goal of reindustrialization unless the dollar is weakened substantially. And so, I keep telling people the dollar, I think, is going to be really the thing to watch. Not the S&P, not the Nasdaq, not even really oil. I think gold and the dollar are really what will have the most signal in terms of, is the administration, serious about what they say, or are they just politicians that are, trying to get votes and money? And the degree to which if they are telling the truth, the degree to which they are successful will be illustrated, I think, by the dollar and by gold. So hopefully, that was helpful in maybe reshaping the way we think about things, especially here in America. I will catch you in the next one.